Hi friends, I am Mani. I am the blogger behind GetMoneyRich.com. Today we are going to discuss the topic of how as an investor we can evaluate profitability of a company. We are going to discuss a financial ratio called return on capital employed. This is one of the most important financial ratios that a potential investor can use to check if a company in consideration is profitable or not. So before we start and get into the topic of return on capital employed, we must know that why we should be concerned about profitability of a company. As a stock investor, we should target to buy only those stocks which are extremely profitable. We do not want to indulge in such companies which are not profitable. And profitable means by investing less capital, they are generating more profits. So this is the meaning of profitability. And as an investor, we will like to buy only those stocks which represent a very profitable business. So return on capital employed is one such financial ratio which highlights most profitable companies at its best. So while we are trying to understand return on capital employed, it is also necessary to understand that use of only return on capital employed is not enough to judge the overall profitability of a company. So it is always better that we use return on capital employed in combination with another financial ratio called return on equity. A combination of return on equity and return on capital employed gives a much wider picture about the profitability of a company. So before we understand return on capital employed, let's try to understand what is return on equity. In terms of formula, the formula of return on equity is net profit divided by shareholders' equity. What is net profit? Net profit is the profit of a company after it has paid all the depreciations, interest, tax and everything. This is the net income that a company has in their pocket. So return on equity is net profit divided by shareholders' equity. What is return on capital employed? Return on capital employed is operating profit, EBIT, divided by total capital employed by the company. So in terms of formula, the return on equity and return on capital employed is this. To understand the relationship between return on equity and return on capital employed, by closely looking into the formulas, we can find a correlation. So return on capital employed is EBIT. EBIT is net profit plus interest plus tax. And the shareholders the total capital employed is shareholders' equity plus long-term debt. So you can just by looking at the formula, I hope you can understand the relationship between return on equity and return on capital employed. Now we will talk in more detail about these ratios. Return on equity highlights the profitability of a company with respect to the amount of money the shareholders have invested in that company. So suppose the shareholders have invested 100 rupees and the company is generating 10 rupees of net profit, then it means that the return on equity of this company is 10%. Similarly, return on capital employed is the amount of profit the company is able to generate per rupee of total capital invested in that company. Now, suppose the total capital invested in a company is say 150 crores and the operating profit that company is generating is say 12 crores. So it means that the return on capital employed will be 12 crores divided by 150 crores is approximately 8%. So this is the way we can calculate return on equity and return on capital employed. So you can see return on equity highlights the profitability of a company with respect to the amount of money the shareholders have put in that company. Similarly, return on capital employed highlights the amount of operating profit the company is able to generate with respect to the total money that has been invested in that business. So, in general language, we can say that return on capital employed highlights the overall profitability of a business, whereas return on equity highlights only the profitability of the company with respect to its shareholders. So how these two are different? There can be a company which is generating okay returns for its shareholders, but when you look at its return on capital employed, suppose those numbers are very less. So as an investor, should you invest in that company which has a high ROE but a very low ROCE? Ideally speaking, for a shareholder, high ROE should be more than enough. But for those investors who want to stay invested in a company for a very long period, for them ROCE also has a lot of weight. So for a company which has a low ROCE today is going to affect the ROE in the future. So as a shareholder, investing in a company which has high ROE and a decent ROCE is an ideal combination. So to understand the concept of return on capital employed, it is necessary for us to understand what is this capital employed. The concept of capital employed can be understood like this. Suppose you are a businessman who has invested 10 crores from your pocket and you have started a business. So this 10 crore is the equity, the shareholders' equity that we have seen. It is the shareholders' equity because the owner's money is called shareholders' equity. So you have invested 10 crores. So how you will use these 10 crores? These 10 crores equity, you will use it to buy a land, to say build a factory, to install some machineries, to hire people, and you will also use these funds to buy raw materials, to pay the salaries, to pay the bills. So all these activities you are doing to produce some goods and services. Once the goods and services are produced, you are going to sell it in the market to your customers and get the money back. So suppose now you have set up a business with this 10 crores and you are doing a decent business. Now you want to expand, but you do not have money in your pocket to put more into equity. So what you can do to expand? You can approach a bank and take a loan. And suppose seeing that you have already put 10 crores in your pocket and your business is doing decently well, so the bank approves another 10 crore as a loan for your business. So in this case, once the loan is disbursed, your company will have the total capital employed of 10 crore equity plus 10 crore loan. So the total capital employed will be 20 crores. Now, you have taken a loan for your business, and you will use this loan maybe to buy a new machinery or to expand your manufacturing facility or to hire more qualified people, whatever. You will use this loan amount to increase the asset size of your business, and the increased asset size will result in more sales and more profit. So you can see, by taking loan, the idea of expansion of your business is ultimately translating into more profits. So when there will be more profits, your return on equity is increasing. Suppose initially you were making 1 crore profit with 10 crore equity. Now you have 10 more crores as a loan. So the employed capital is 20 crores, and suppose your profit, the net profit has increased from 1 crore to 2 crores. So now how much is your return on equity? The return on equity is 2 crores divided by 10 crores. So it is 20 crores. So by taking debt, you have increased your net profit, thereby increasing the return on equity. But in this case, what will be the return on capital employed? The return on capital employed will be 2 crores of, if 2 crores is the net profit, then let's say 2.2 crores will be your 2.2 crores will be the EBIT, the operating profit, and the total capital employed here is 20 crores. So around 11% will be your return on capital employed. So we have seen how a business can take loan, increase its asset size, thereby increasing the profits. So does it mean that a business can go on piling up more and more loan for the sake of increasing the net profit? No. There must be a balance between return on equity, return on capital employed, and a debt equity ratio. We do not want our business to have too much debt. When the debt equity ratio is 1 or below 1, it is considered acceptable. Such business are less risky. So a decent return on equity, a decent return on capital employed, and a debt equity ratio 1 or close to 1 is a balance. We do not want to indulge in lot of debt and risk all the stakeholders. Now let's understand the concept of return on capital employed and why it highlights and why it is so crucial to evaluate the profitability of a company. I will take two examples. One is Grasim Industries and the other is Crompton Greaves. These are two companies which has their shares in the stock market. Suppose we have to select between the two and we have to decide which stock we want to buy. So the first step, the first approach should be, we want to understand that what is the profitability of the business. So to understand the profitability of the business, the first look should go to how much net profit this company is generating. Grasim Industries is generating around 500 crores of net profit. while the Crompton Greaves is generating around 400 crores of net profit. Talking about EBIT, Grasim Industries EBIT is around 1500 crores and the Crompton Greaves EBIT is around 620 crores. So in terms of return on capital employed, we have to understand this. To generate 1500 crores of EBIT, how much fund Grasim Industries is using to generate this much profit? So if you will see the numbers of Grasim Industries is using 44,000 crores to generate a EBIT of 1500 crores. So it is putting 44,000 crores in the business, and those 44,000 crores is generating 1500 crores of operating profit. But if you will see Crompton Greaves, it is generating around 621 crores of operating profit, but it is investing only 1400 crores to generate those operating profit numbers. On one side, where return on capital employed of Grasim Industries is only 3.2%, the return on capital employed of Crompton Greaves is around 40%. So what does it mean? What does these numbers highlight? These numbers tell us that with less money being invested, Crompton Greaves is generating more profits. So you can see in profitability numbers how ROCE is making more sense. ROCE is saying that out of the total money which is being invested in the company to generate products and services, Crompton Greaves is generating much more operating profit than Grasim Industries. So in profitability terms, Crompton Greaves is a highly profitable company. Having said that, it is also important for us to remember that we cannot compare ROCE and ROE of a IT company with that of a auto company, because every line of business has their own profitability numbers. If you want to buy a stock of a auto company and you want it to generate a profitability numbers like that of an IT company, it will not happen. So better is, if you are investing, if you want to check if the profitability numbers of a company is good or not, you should compare it with other companies of the same sector. Do not compare ROCE and ROE numbers of two different sectors. It is not a right way of comparison. So I hope you like this video. The reason why I have written a blog post, the link I have left in the description. If you want, you can read that blog post. This return on capital employed is a concept which is so basic, and it so easily highlights the profitability of a company that I thought that I should write a blog post and also post a video on this topic. I hope you like the concept, and if you like this video, do subscribe to my channel and press the bell icon so that whenever I post a new video, you will get a notification and you will not miss any video.